Oh, can you hear or that's good? Okay. Okay, look at the course content. So we have this week, this is the last week, we have lectures, and the final exam is due by Sunday, May 9. So anyone of you is going to graduate in May?
No.
No, okay. So that's good. So if you are graduating senior, so please let me know because I will report your grade early. If you're graduating senior, so it's going to have your grade reported to the university by May 4th. Okay, May 1st. That means you have
Actually,
to
we are a cohort, so we all graduate during summer.
or graduate in the summer. Okay, so yeah, I know the graduation ceremony is going to be postponed to August, I think. Yeah, that's a graduation ceremony. But the graduation ceremony and the graduation date are different things. So if you planning to graduate in May for this year, so you will have to get all your grade into the university by May 4th. Okay, and that's gonna be next Monday, okay, 1 o'clock. So basically that's for graduating senior. So we have okay, we have those final exam right here is already posted in week 7 and 8 reading assignment. So basically, today is the last day we have lecture, so I'll give you 1 more days to work on your final exam and answer your questions. So, okay, make sure, so next week, we do not have any lectures, that's the last one, okay, for this week. So we talk about chapter 7 and week reading assignment. 2 topics. One is a cost of capital, another one is taxation and business organization. Okay, now we get started. The theme, we're gonna have 2 sessions today. The one session gonna end in about 40 minutes. So later, so we're gonna have the first section end. And after that, we take about like a 5 minutes break, and then we come back and do the second session about the business organization. Okay, the cost of capital, we talked about, this is our learning objectives. So basically we're gonna do is to estimate, okay, the weighted average cost of capital. So the weighted cost of capital, the first you compute the cost of each source of capital, and then you determine the percentage of each source of capital in the optimal capital structure. And then you calculate weighted average cost of capital. Okay, you calculate WACC. So we call them WACC. So basically, when you have a company, you have 3 different components. Okay, 3 different components. Or sometimes you have only 2 components, but most of the time you have 3. So let's say we have the components we have. I give you a general idea how it looks like. So for example, we have the total assets. So you know, last time we talked about the financial statement, right? Total assets. So all your total asset will be equal to your total liability and the total owner's equity. This is your total liability and total liabilities, and your total equities. So the equity means stock, right? So the liability means bond. So you have a bond, and this is equity, that means the stock. So the total owner's equity, you could be two different type of stock: the preferred stock, okay, preferred stock, and it could be common stock. Okay, that's your total asset. Typically, your total asset always equal to your total liability plus your total owner's equity. So, equities. But the equity part, you have preferred stock and a common stock. So you look at all these three different components, okay? There is a trend. The trend is basically the bond cost is lowest, okay? The cost of bond is lower, okay? Is all the lowest. And then the preferred stock is cost is higher than bond, but lower than common stock. So the common stock, usually the cost is the highest, and then the bond cost is the lowest. Okay, we call this one is, in finance, we call this one is called a pecking order theory. Okay, the pecking order theory says, okay, pecking order theory says, okay, the company trying to use their internal fund. Internal fund is the money they already have, okay? Use the money they already have, and then use bond. That's borrow money using bond, and then they go preferred stock, and the last result is common stock. So issuing common stock is the company's last resort. For a company, they do not have any other choice. They will issue common stock. So common stock is cost the highest. So what will be the weight looks like? Okay, so we leave this cost right here, and we calculate the cost later on. So the weight is going to be like something like this. Okay, so if you issue, you raise capital using like a bond, you issue like a 40%, right? 40% of bond, 10% of preferred stock. And what will be the percentage of your common stock? Okay, it will be 50%. Okay, why? Because you have to add them up equal to 100%. So this is the weight of bond plus preferred stock and preferred common stock. So that's the total. You will be 100%. The 100% cover all your different way of financing. So basically, your total asset was composed of these three different components. Each component will be part of your financing. So you can just, let's say you do a graph, it will be like a pie graph. It looks like a, okay, like this, okay? So the chart is looking like this. So this is second item, this 2 is your this is your preferred stock, and this is your bond, and this is your common stock. So the whole pie, this is the total assets. So your total assets, okay, your total asset will be 3 different components. Okay, 3 different components. And those 3 components, sum them up is going to be 100%. So the 100% is exactly equal to the whole pie, right? We call this one like give you an example. It's like you have a pizza, right? You buy a whole pizza and you cut it into different slices. Most frequently, and is we cut the pizza into 8 slices. Okay, 8 slices. But you know, this one is cost of capital is you cut into 3 slices. Okay. Okay, so we know that this is the weighted average cost of capital. The first we have idea, okay, the weight or the proportion of each type of asset in your total asset, or the weight of each type of asset in your total asset. Okay, now we go back to the cost. So as what I have mentioned that the bond costs the lowest and the preferred stock in the middle, and the common stock, the cost is the highest. So now we see, okay, the example we have. So the first we wanted to compute the cost of debt. The cost of debt, okay, remember the cost of debt, same cost is like we have before tax cost of debt is 10%. So let's say this is a company, they borrow money or issuing bond, that cost is 10%. Okay, can we just use the before tax cost of debt? Can we use the before tax cost of debt? Actually, this is a very good question. Should we use before tax cost of debt? Okay, the answer is no. Okay, why? Because the company, the interest payment may be tax deductible. Okay, interest payment is tax deductible. So the company, the true cost of that is after tax cost of debt. So this part, you know, we're gonna talk about the interest payment. Why this interest payment for a company is tax deductible. Later on, we talk about the different type of business organization, and we'll tell you why. Okay, the interest payment for a company is tax deductible. That means either you pay higher tax, or either you borrow money, you pay high interest. So that means the current like a tax rule or the tax policy encourage companies to borrow money, because if you borrow money and you pay interest, okay, you pay interest and that will save you your taxes. So either way, so either you pay tax or either you pay interest. So comparing these two, so most of the companies saying, oh, it's better just pay interest instead of pay tax. So the true cost of the debt is after tax cost of debt. So for example, if this company, their tax rate, okay, the tax rate is state tax rate and the federal tax rate combined is 25%. And the after tax cost of debt, it will be that 10% times 1 minus the tax rate. Okay, 1 minus tax rate. So This is for the corporate tax, okay, for corporate tax, national level. So after 2008, Donald Trump came into business, came into administration, and we have a tax cut policy. So the corporate tax cut to 21%. Okay, that's a federal tax rate is a 21%, and state and local tax 4%. So we got this information, so we can put them together, like say the cost of debt, right? So we know the cost of debt. Okay, the cost of the debt, okay, before tax. Okay, before tax, the cost of the debt is 10%. Okay, and we are not going to use the before tax cost of the debt. We have to use after tax cost of the debt. So it's going to be after tax. Okay, so after tax cost of debt is that before tax cost of debt times 1 minus, okay, the tax rate. So the tax rate, let's say 25%. So we see the after tax cost of debt is going to be the before tax cost of debt times 1 minus the tax rate. Okay, that's the real cost of debt for the company. Okay, that's a 7.5%. So we use that 7.5% for the cost of debt. Okay, now we wanted to estimate the cost of preferred stock. Okay, let's go back to the cost of preferred stock. Okay, and what I wanted to mention is that the Tax Cut and Jobs Act of 2017 impact on cost of debt. So this is a new tax cost and job act. So I talked about that before Donald Trump, and to reduce the tax of the company, right? Companies reduce the tax. So that is the new one is 21%. Okay, 21% for the company. And so now we see preferred stock. So how to estimate the cost of preferred stock? The preferred stock, we can consider that a preferred stock as a perpetuity. So the preferred stock cost is going to be the dividend divided by the market price. Okay, dividend of the divided by the market price minus the flotation cost. Okay, flotation cost, what is a flotation cost? The F is, flotation cost is the percentage of your total cost. Okay, the percentage of your total cost. Okay, that cost is the money you give it to underwriters. The underwriters, for example, like investment bank, will help you to issue preferred stock. So in this case, we have an example is, for example, you can issue preferred stock for a net price of $42, and the preferred stock pay a $5 dividend. Okay, so the required rate return of preferred stock is going to be the dividend, okay, $5 dividend divided by the stock price, okay, which is the market price. So it's going to be $5 divided by 42, which is the market price of that preferred stock, 11.9%. Okay, so now we have preferred stock. So the cost of preferred stock we have the cost of preferred stock Okay, the cost of preferred stock is going to be dividends, the dividend and preferred stock price. His dividend is $4. Okay, it's $5 and the price of 42. Okay. $5 divided by 42. Okay, that's a dividend, $5. And the preferred stock is 42. So we can say the cost is going to be that dividend divided by the preferred stock price. That preferred stock is $42. So the preferred stock cost is 5 divided by 42. Okay, so we make this one as percentage, so we don't increase the decimals. We can say the preferred stock cost is 11.9%. Okay.
I have a question.
Mm-hmm.
Here, what about the F that you mentioned earlier? The fluctuation cost.
Oh, the flotation cost.
The flotation cost, yeah.
Yeah, this question they didn't mention that flotation cost. Okay, for example, if they have flotation cost, let's say 5%, okay? So 5%, we can calculate the flotation cost is F is going to be equal to, let's say we have enable this. Okay, so we can calculate the flotation cost, or usually they give you flotation cost is not a dollar value, it is a percent. Yeah, so it's going to be, let's say flotation cost is 5%, and then you will use that 5% times 42. Yeah, that's market price. Okay, we'll get to, this is, okay, $42 times 5% is 2.1. So you will see, okay, that's your flotation cost. Okay, so we see, we can have here. Okay, you have this one, right? So then you will be the preferred stock cost will be the dividends divided by this $42 minus your flotation cost. Okay, changes that percent into a dollar value. Okay, you can say your preferred stock cost will be higher and when you exclude the flotation cost. Okay. But this one, we do not have a flotation cost. They just mentioned that. Yes, that's fine. Okay. If they have flotation cost of about like a 5%, you need to minus that. Okay, so the most important part of that is to calculate the cost of common equity. So the common equity, we have two different ways to calculate the cost of common equity. And the most important one we use is called the dividend growth model. Okay, we have a dividend growth model, and that is the okay, we typically use. Okay, dividend growth model, the required rate of return of common equity is using the D1 divided by current stock price plus G%. Okay, so that's a dividend growth model. So we have cost of common equity, common stock. So we can do is using dividend growth model. Okay, dividend growth model, and you can see we have several things. Okay, is the D1, the P0 plus G%. So what does that means? Okay, so the D1 is the dividend at the end of the year one, and the P0 is the current stock price, and the G is the dividend growth rate. Okay, so for example, we have a market price of a share of common stock is $60. The dividend just paid is $3. Okay, the dividend they just paid, okay, we need to mention that this is the current dividend they just paid is going to be used in D0. Okay, as a D0, that's just paid. It's now D1. Okay, D1 is different from the dividend they just paid. And expected growth rate is 10%. Okay, so the first step is we need to know the dividend D1. So what is D1? D1 is going to be the D0 times 1 plus G%. Because the dividend, they increase G% every year, so increase 10% every year. Okay, so given that information, we have P0 60, right? Okay, the dividend they just paid is 3. Okay, so now we have, we're using dividend growth model. Okay, P0 is the current stock price. Okay, and we need to calculate the D1, which is the dividend they will get at the end of the year, and also the G%. Okay, dividend growth rate is 10%. We have a current stock price is 60. The current dividend just paid is 3, right? Okay, so we have $60, and the current dividend. Okay, so notice that in the formula we are going to use as D1. Okay, it's not D0. So what is D1? The D1 is going to be maybe we tap here. So the D1 equal to D0 times 1 plus G%. Because the dividend, they increase G% every year, right? So every year they increase G%. Okay, that's the D1. So we have D1. The D1 is equal to D0, which is $3 times 1 plus G%, okay, 10%. So we get the D1. Okay, so the common stock we have on this rate. Okay, the common stock using dividend growth model we have equal to D1 divided by P0 and plus G%. Okay, that's your common stock, the cost of common stock. Okay, we get 15.5%. And that's a dividend growth model, so we know that is equal to 15.5%. Dividend growth model. And also we have another one is called the capital asset pricing model. And not only the dividend growth model, we have capital asset pricing model we can do is using the cost of internal common stock equity using capital asset pricing model. So what is capital asset pricing model? Capital asset pricing model, you estimate the cost of common equity. Use this one, this is the risk-free rate, and this is beta, and this is the market return minus that risk-free rate. And okay, so this is called our market risk premium. So this part in the parentheses is a market risk premium and times beta. Okay, so basically we need to know the risk-free rate, beta, and market return, and then we can calculate the cost of common equity. Okay, let's see, we have an example is that the estimated beta of a stock is 1.2, right? Okay, this beta is 1.2. And the risk-free rate, the KF, RF, 5%. And expected market return is 13%. Okay, now we have some of the information here. So remember that we have a risk-free rate. Okay, we have a K risk-free rate, and we have a beta, and we have a return of the market, right? The return of the market. So we have a K return of the market. Okay, look at the risk-free rate is 5%, 13%. Okay, 5%, risk returns 13%. Oops. And then you have beta 1.2. Okay, so what is your cost of a common equity? Okay, the cost of common equity, remember, is the formula is the risk-free rate plus beta times, okay, times market return minus risk-free rate. Okay, that's exactly the capital asset pricing model we have. It'll give you 14.6%. Okay, so for the common equity part, the cost, you could use this one or either this one. Okay, which one you're supposed to use is based on the information, okay, you have. Sometimes they give you the dividend growth rate, sometimes they give you beta. So different type of information will give you different common stock return. Okay, now we have the cost, okay, all these three different component of asset, and we have the weight. So now let's say we go to the weight, right? Okay, the same thing if you have a new common stock and this current stock price, you minus that flotation cost. Okay, it will get you a new common stock. So for example, like if additional share is issued, flotation cost will be 12%. And then you will minus that 12% of the flotation cost right here. Okay, use that 12% times the price, the stock price. So based on that formula, so if you have a new issuing, okay, we calculate that the new issuing is going to be D1 divided by the current stock price, $60 minus 12% of the $60. That's the flotation cost. And your issue new stock is 16.25%. Okay, we just got this new stock. Okay, if this is a new stock, okay, is 16.25%. Okay, so let's see what is the weight of each type of asset. Okay, this is the weighted average cost of capital. So the weighted average cost of capital equal to the weight times the return, weight times the return, and sum them up. Okay, so it's like a debt 40%, 10% preferred stock, 50% of common equity. So we can calculate, okay, the weighted average cost of capital. Let's say the WACC. Okay, weighted average cost of capital. You can use a sum product. Okay, you select the cost and the comma, and you select the weight. Okay, I give you a little bit more time. You can figure it out. Sum product, the cost, and the weight. Okay. So that's how you calculate the weighted average cost of capital. Okay, 11.94%, right? 11.94%. Okay, so that's this is a cost of weighted average cost of capital. So they use a 15%, but that's fine. Okay, very close to what we got here because they're using 15%. Okay, rounded to one decimal. We rounded to 2 decimals. Okay, any questions? Okay, now so we are closing to finish the first session, and I'm going to end the meeting. And about 5 minutes, we come back for the second session. Okay, I will upload this file to Blackboard so you can see. Okay. Okay, and let me end the meeting now.
Okay, see you in 5.
Okay, see you in 5 minutes.
Okay.